Hello, welcome everyone. Um, Thank you for joining this week's Market Huddle. My name is Bradford Allen. I'm one of the financial advisors here at Secured Retirement. And today's topic is biannual beneficiary checks. More specifically, we're going to be looking at 5 mistakes to avoid when working with beneficiaries related to your assets. Before we jump into anything, we do have to show the weekly disclosure. Again, anything discussed during this market huddle is general information only. It's not meant to be taken as customized investment advice. We're not CPAs and we're not attorneys. So going forward here, the first thing to keep in mind is that your will does not control all assets. So what this means is just because you have a will established doesn't mean that all the beneficiaries on any of your accounts are taken care of. It's important to look at every single investment account you have, as well as real estate. So looking at the first bullet point here, assets that can be transferred using a beneficiary designation will decide who receives that asset upon your death. So for a lot of accounts, there's a beneficiary designation that can be made for the account, which is separate from your will. So looking at life insurance, annuities, IRAs, 401k plans, those all pass directly to your beneficiary using a beneficiary designation, not necessarily through your will. So looking at joint or non-qualified, non-retirement investment accounts, they have a similar thing, which is called the TOD or POD, which is a transfer on death or pay on death. And you want to make sure that those are established on your accounts so that in the event that something happens to you, the assets are transferred to the listed beneficiaries without going through probate. So just because you have a will set up doesn't excuse you from going through each of your investment accounts and making sure that there's a beneficiary designation for all retirement accounts. And for the non-retirement accounts, you can add primary and contingent beneficiaries through a TOD or POD form. The second item here is to double check on missing and incorrect information. So it is important. I want to move my cam here. It's important that everything's checked twice. As far as spellings, it's very important that the beneficiaries' names are spelled correctly. In some situations, you'll be working with, someone who might be a senior or a junior. It's important to double check that and, name changes. For example, maybe you have a daughter who's single. She's listed as one of the beneficiaries on your accounts, but she gets married, and it's important to keep everything up to date. So you would want to go in and edit the beneficiary name so that it's updated for the new last name. The other things that can happen from time to time is maybe the institution where your accounts are held have a major change. For example, a merger or a migration to a new system. It's always important just to stay up to date on things going on with your custodian and make sure that if there's a merger, that all the beneficiaries on your accounts they transfer over to the new custodian accordingly. Number 3 is to have a plan in place. You want to, use a spreadsheet or some document where all of your assets are listed and it's assigned which asset is set to be transferred to which beneficiaries per account. So what we do here at Secured Retirement is we have a beneficiary designation sheet for all clients so that for every account we know exactly how the beneficiaries should be set up on each account. And another thing that's good to consider is to establish a revocable living trust. what that will do is it helps have more control on how your assets are distributed. And specifically, it helps to avoid probate, and it adds a layer of privacy to your beneficiary transfers. A trust can make a lot of sense for most people, but especially people who have a lot of real estate, maybe real estate in multiple different states. That's when a trust really makes a lot of sense. But for a lot of clients that we see, establishing a revocable living trust does make sense, and any non-qualified assets would be owned by the trust once established. Same with real estate. Retirement accounts, however, do not have to be owned by the trust. Instead, like we touched on earlier, they just use the beneficiary designation, and on the event that something happens, the assets within the account are transferred to the listed beneficiaries, and they avoid probate. So something to keep in mind with trusts is that retirement accounts they shouldn't be owned by the trust, but a contingent, like the beneficiary, usually your contingent beneficiary might be the trust, and any non-qualified assets would be owned by the trust itself. The other thing to keep in mind is the use of secondary or contingent beneficiaries for an unexpected event. So, on every account that you have, you'll have the option to list primary beneficiaries, and then you can also do secondary beneficiaries which are contingents in case something happens to the primary beneficiary. There's a plan in place on who the assets are transferred to. So it's important to, when possible, we do encourage clients to add contingent beneficiaries to the accounts on top of the primary beneficiary. Number 4, we're looking at complexities. You have to consider, a complex situation, and some of that might have to do with minors. There are rules on having minors listed as beneficiaries. A lot of times, if that's the case, you want to look at a trust or a account that can be held for a minor, which we'll touch on here shortly. But the other thing is individuals with special needs or someone with the inability to manage assets. Maybe it's a maturity issue. Anything. Maybe they're in a lot of debt. But when we're working with families who might have a beneficiary that has special needs, a lot of times what they'll do is they'll establish a supplemental needs trust or something along those lines, which is a document that sets in place exactly how assets are to be transferred to the beneficiary with special needs. There's a little bit more control over how that happens, which makes sense and is often required for minors or people with special needs. The other thing is, an influx of money can have a negative impact on a beneficiary's finances. For example, if a beneficiary maybe has some maturity issues or spending issues, sometimes it makes sense to control the transfer a little bit more with a trust document so that the money isn't all transferred to, let's say, your son, where he can go and spend freely as he wishes. So there are things you can do to provide more control on your assets before they are transferred to the beneficiaries. And then the last item here, number 5, is remember your legal and financial advisors. So we're here to assist, to ensure that all accounts are set up appropriately and that for every single account, there's beneficiaries on file so that a smooth transfer of assets will occur in the event that something happens to you or your spouse. What we'll do is we'll go through each accounts together, make sure all accounts are set up correctly, and then we'll keep a document on file on exactly how your beneficiaries, how you'd like them to be set up so that anytime a new account is opened, we know exactly where to refer to. And same thing with trusts and wills. For most clients, at some point in their lives, it makes sense to establish maybe a revocable trust in addition to the will. Oftentimes we'll see a power of attorney document as well. and a healthcare directive. These are all things that you want to keep in mind as you get closer to retirement or as you're in retirement, to ensure that your assets are all set up the way you want, and that you have full control over how they're distributed in the event that something happens. So, make sure you're talking to your financial advisor about these sort of things. Also, we work closely with different attorneys. If you were interested in, establishing estate documents to better control some of these things, we're happy to refer you to some of the attorneys that we've worked with over the years. Let's see, and then I'll come back to questions here at the end. So really, the overall point here is do a biannual beneficiary check on all of your assets. Maybe not a whole lot has changed, but maybe you have a daughter who got married and needs to update her last name. Small things like that are always, you always want to stay on top of it, because a small typo or something along those lines can, unfortunately, really burden the process of distributing the assets to the beneficiary. So if you check biannually, you're going to have the highest likelihood of having everything set up exactly how you want. So some of the accounts we're talking about here is life insurance and annuities. We want to make sure your beneficiaries are appropriately set up for that, both primary and contingent beneficiaries, especially when you're talking about these accounts that have death benefits associated with them. You want to make sure that transfer of payment goes as smooth as possible, without any hiccups and without any probate or governmental control getting involved. We're also talking about 401ks and 403bs, all retirement accounts, IRAs, Roth IRAs, simple IRAs, etc. They should all give you the option to list not just primary beneficiaries, but contingents as well. And once those are set up, they'll go directly to them without going through probate. Bank and brokerage accounts, same thing here. Instead of the beneficiary designation, these have the TOD or POD, transfer on death forms, that also allow the transfer to go smoothly without probate from these accounts. These are also accounts that if you had a trust set up, you'd want them to be owned by the trust instead of owned by you. 529 education accounts, same thing here. Want to make sure that beneficiaries are set up appropriately there. And then real estate, that's when we're talking about the TODs, a home deed, transfer on death. It's important to have that set up for all real estate. Same thing with any business accounts or health savings accounts. Benefits of the gifts of appreciated assets. So this is another thing to consider here. What we see in some cases, it has to do with beneficiaries. Sometimes it makes sense to gift, if you want to gift some money, to gift stock or some appreciated asset. And if you do that to someone in a lower tax bracket, you can really help your own tax situation, as well as not really burden the receiver too much either. For example, we have clients who, maybe they have a plan where they give their kids a certain amount of money per quarter. What often makes sense, depending on the receiver's tax bracket, is we'll often recommend that we gift an appreciated stock instead. That cost basis then steps up in basis. So yes, once the receiver sells that stock, they have to pay any capital gains tax. However, what we often see is they might be in a tax bracket low enough to where they don't have to pay any capital gains tax, at least at a federal level, sometimes at a state level as well, depending on the states. Here in Minnesota, you do still have to pay the capital gains taxes for the state, but that's something to keep in mind when you're considering gifting to family members, how gifting an appreciated asset might make more sense for you in your tax return, and it also won't affect the receiver's tax return too much depending on their income level. The other thing here, you can fund a college savings account. Those are great ideas. Those are great accounts to have if you just want to sock away some money for, let's say, your child to help with college or other educational expenses. The thing to keep in mind here is that there's a few different accounts you can use. There's the 529 plan, And then there's also the UTMA account, which stands for Uniform Transfer to Minors Act. The number here is the $21,000 each year. That's where there's a distinction between the two. If you have the UTMA account and there's unearned income, for example, capital gains, if that exceeds $2,100, you'll likely have to pay tax on those gains in the UTMA account, even though these accounts are designed to provide tax-free growth if they're used for qualified education expenses. What you got to be careful with in a UTMA account is that if you have more than $2,100 in unearned income, they will tax that money and it'll be taxed at the parent's highest tax bracket. When you use the 529 plan, those grow 100% tax-free when used for qualifying education expenses, and there's no threshold that you have to worry about with capital gains. So the 529 plan has a little bit more tax benefits in the sense that it doesn't matter what capital gains you generate. It's all going to grow tax-free if used for a qualifying education expense, tuition, etc. The other thing to keep in mind is age 24 and the kiddie tax and how that pertains to full-time students. This has a similar number here where if you have a child on your tax return and they have unearned income of less than $2,300 or of higher than $2,300, you start to have to pay some of that tax at your tax rate, the parent's tax rate. If the child is not a dependent anymore, then you don't have to worry about that. This is only for children between 19 and 24 who are dependents on your tax return, or anyone below age 18 where they're not considered full adults. So you got to keep the kiddie tax in mind. And then in general, gifting appreciated assets can offer significant tax savings for business owners looking at lower capital gains. And then before we wrap up, just want to keep you guys in the loop on our upcoming events. On Monday, June 20th, we will have a market huddle. Again, the subject will be growth and value investments, and we'll have Tony Schink from Minneapolis Portfolio Management Group. He'll join one of our advisors, Ryan Dillon, for a discussion on growth and value investments, specifically some of the differences between growth and value stocks and Tony's outlook going forward. And then Monday, June 27th, we will have a lunch and learn here at the office. Joe Lucy will be the host. He'll talk about his new book that is being launched called New Tax Secrets. That is now available. So please join us if you can on Monday the 27th. And then just a reminder, we will be closed on Monday, July 4th. Any questions or comments, please reach out to us. You can reach us via email at info@securedretirements.com or by calling us at 952-460-3260. But now I encourage you, if you have any questions, to please put those in the chat. John, looked like you tuned in a little late. Number one was that your will does not control all assets. So the key on that is, just because you have a will established doesn't mean that all of your accounts and other assets are taken care of as far as beneficiaries listed. Each individual account, you're going to want to go on and add primary and contingent beneficiaries, even though you have this will that some people might think just takes care of it all. So your will does not control all assets. Each account will have the ability to add specific beneficiaries. Kurt, looking at your comments here, is the beneficiary always the first priority over will and other docs? And what we'll see here is that for retirement accounts and non-qualified investment accounts, if you have the beneficiary designation, it is number one priority over your will per se. It's going to follow exactly what's on that specific account, even though you have a will in place or a trust in place. So yes, it is always the first priority. You want to make sure each account has the correct people listed, even if you have a will or trust set up. And if you did just recently set up a trust, I'd encourage you to make sure your financial advisor has a copy of that and can retitle accounts and change beneficiaries if needed according to the wishes of the trust. If the beneficiary is not alive, then what happens? This is the importance of having not just one primary beneficiary, but maybe contingent beneficiaries. You can also have tertiary beneficiaries. However, what would happen here is then it would go through probate. Let's say your primary beneficiary on the account is no longer alive, then it's basically like there's no beneficiaries on the account, and that's when it goes through the probate system. Having a trust in place can help avoid that in any probate. But yes, if there's not any other questions, thank you guys for tuning in today. I hope you have a great week. And if you have any questions, reach out to us via phone or email, and we're happy to discuss. Thanks.